Okay, guys. Well, I'm going to go ahead and get us started. It's 9:03, our designated start time. Welcome. Thanks for making it. I want to apologize in advance because my AirPods are dead. And if you guys hear at some point my crazy cat yelling in the background, I just feel like it's going to happen. So I'm just apologizing in advance. We are joined today by Matt Davis of Caliber Home Loans. Matt, thanks for being with us. We're going to go ahead and jump on in and start asking him questions. But if you guys have anything that you want to ask, you can go ahead and drop it in the chat while we're going through ours. And then at the end, I'll leave space for you guys to unmute yourself and ask him directly. So, Matt, can you start by telling us a little bit about yourself, like maybe even like where you grew up, how'd you get to Indy, and then can you go into how you got into lending and getting to Caliber?
Yeah. So grew up in Fort Wayne and then went on to Purdue and then came down to Indy. Actually, I was going to basically move out west. I had no idea what I was going to do, but I just wanted to move out west until I met a girl right before I graduated. So decided to come to Indy, live with my brother and sister-in-law in an extra room. Just to see if it was going to work out. So I took a dead-end job and did that for 2 months. That didn't work out. And then, thank goodness, though, because I ended up marrying the girl. So while I was living there, my brother was actually doing mortgages, and he had been for a while. So he asked me if I wanted to go ahead and try that out. So that was almost 19 years ago. So I guess it worked out. So.
Is your brother still doing mortgages?
Yep, and we work in the same group. Not together because we love each other too much. We've actually worked for the same group of people that entire time. So the person that hired him 26 years ago is still over our group, which is pretty crazy.
And you guys, so you're both at Caliber then?
Yep.
That is so wild. And that's where you started 19 years ago.
Yeah, it's different company. It's evolved over the years, but same group of people, same management.
That is crazy. What was your journey like to become, like, did you start off as a loan officer or do you start somewhere like more entry level? What does that look like?
Yeah, no, that's a great question. So I had the option. I could just start out as a loan officer and just basically fend for myself with the wolves. Or I could go ahead and be an assistant for one of the top producers at the time. So I chose the route to be his assistant for just under a year, which was perfect because when I went in, there was a group of us all going in at the same time. I was the only one that went in as an assistant, and I saw over 600 loans that year. And so I saw a lot of different transactions and so on. And a year later, when I came out, the others had saw about 10 or 12. And none of them made it. I was the only one that survived, and I truly attribute that to the experience as far as being under someone that knows the industry.
I'm curious, in the world of like loan officers, like very similar to how real estate is, like there's a lot of turnover in terms of agents. Is that the same for loan officers?
Yep. And it's hard to get in just because the same thing as far as building up that client base and being able to survive and kind of getting over the hump. So yeah, it's the exact same. I think the average age of a loan officer is in the young 50s.
Wow. Yeah. Yeah. Matt, tell me a little bit about what your day-to-day looked like before coronavirus, and then tell me a little bit about how your life has changed since the pandemic hit.
Let's see here. So, I mean, since I've been going in the office, that really hasn't changed that much, except what coronavirus has been over the last couple of months is that, so back in 2008 and 2009, there's basically, they call it the whole meltdown, the housing industry. And it took about 2 years to go through that cycle. And what we've experienced, we basically kind of that 2008, 2009, a lot of that has happened in like a 2-month period of time. And so, going into the office and so on has been the same, of course, less people, but just watching so many quick changes over that period of time to where it went into an incredible run of mortgage companies were filling up their pipelines with purchase and refinances, to extremely low interest rates, to all of a sudden everything came crashing down to where rates spiked up over 1% in a day. Every day they're bouncing about 0.5% to 1% for a while because there's a thing called a liquidity crisis, to just a lot of unknowns and panic and so on. So it was just every day was a really take it by about an hour at a time on the reactiveness of it. But it's at least, thank goodness, is over this last month I really have seen a lot of it stabling, and it's kind of getting back into the normal market again.
That's great. Can you explain what a liquidity crisis is?
Yeah, it's basically where banks or lenders don't have enough money to lend. So the government, without getting too complex, but it's kind of think of if you're operating your business, let's say you have a manufacturing company and you have a credit line of maybe like $100,000 and you're always maxing it out. All of a sudden your line breaks down and you just manufactured a record amount of goods and you're ready to go sell it all, but you need your line to be running. And so you call the creditor, you say, hey, can I get an increase in my line real quick so I can get back into business? And instead they say, sorry, we're going to decrease it by half and you have to pay everything now. And by the way, everything you just produced, instead of getting paid, you have to pay to get rid of it. And so that's kind of what happened overnight. Yeah. So when the government stepped in and they went ahead and they lowered the Fed rates and so on, and they jumped in to help, they inadvertently went ahead and caused a big problem across the board of lenders. So that's what you've heard on the news. A lot of these lenders are trying to figure all that out, which again, it's been stabilizing, but it's going to be interesting to see what happens. So yeah, hopefully that answers the question.
No, that totally does. Thanks. And can you talk, you just said that things are starting to stabilize a little bit. Can you talk about that and maybe like, why is that happening? What does that look like for you?
I think a lot of it is that confidence of people with the pandemic that's going on. I've seen for a while there, I think there was so much fear that people were just kind of waiting to see, is the end of the world coming? And then now that things have flattened and realizing, okay, you know what, at least I think things are going to be okay. It's going to be different for a while. So I think that's one thing that's caused a lot of people to come back out to start getting pre-approvals again, getting under contract. And so things have really stabilized that way.
Yeah, that makes total sense. I feel like a lot of things are starting to become more normal. Yeah, it makes people feel a little more comfortable to get out there and buy and sell. So, okay, but some things have changed. Can you talk about some of the changes that we're seeing in FHA and VA loans throughout this?
Yeah, so the lenders and banks have tightened lending requirements just because they're concerned about what is it going to look like with a lot of people's loss of incomes or reduction in incomes, especially for FHA and VA. The performance levels on those are not as good typically because it is typically lower down payment and lower credit scores and not as much cash reserves. So they've tightened that to where credit score requirements have increased across the board. Most lenders have moved to 620, 640, 660, even higher. We've gone to 620. We were as low as 580. But again, they were just worried about, are they going to be able to pay the mortgage after they close on the loan? So that's one thing that's changed, our credit score requirements. The other is if someone's getting a gift, and a lot of it I think is kind of common sense approach. So, someone with a lower credit score, probably a better chance that they may default on the mortgage. If someone has a gift for the down payment, better chance that they may not go ahead and repay it because it's not their own money. So if it is a gift, now we require 6 months reserves. So just some minor changes like that. And it's going to be temporary, but we don't know if that's going to be, the next month, the next 6 months, we have no idea.
That's helpful. This is more of a basic question, but how can someone improve their credit if they need to?
A lot of different ways, but one is, of course, make sure they pay their bills. But the biggest one that a lot of people don't know about is it's called utilization ratios. So to have credit cards is actually you have to play the credit card game, and it's a great way to go ahead and keep your credit scores high or improve them. And it's all about keeping the utilization ratio low. So meaning it's if you have $1,000 limit, you want to at all times keep it less than 25%. And they look at average age of accounts. So the longer you have accounts open, the better too. So for people that play the game of opening and closing credit cards, it actually hurts. And then lastly, is a lot of people don't know is that even if you pay off your credit card in full every month, but let's say if you have $1,000 limit and you put $800 on there and then you pay it off, that $800 was reported to the creditors and it makes it look like they maxed it out. So it's, if you are going to have a higher balance that month, maybe due to traveling or whatever else, go in during the mid-cycle and pay it down to make sure it gets reported at a lower number.
Okay, that's helpful. Thanks. What are you looking at? What job industry a buyer is in, or can you talk a little bit how like unemployment is affecting loans, all that good stuff?
Yeah, so I think it's probably a little bit of a common sense approach when underwriting is looking at these. And then also when every client I talk to now is one of the first questions when I'm going through an application is, have you been affected by COVID financially? Has income been affected? Number of hours? We have to go through and ask those questions, and in every single industry actually. So, underwriting and across the board is where we do have to validate the income for everyone. I mean, it's of course the food industry has been affected tremendously, but there's a lot of others that you wouldn't think so, and they have taken pay cuts. Even engineers for different companies, they've taken 20% pay cuts and so on. So it's just asking the questions up front, and then also even asking the question, even though it hasn't now, do you foresee that being a possibility? Just so we kind of have an idea of what we're getting.
Yeah. Jenny just asked in the chat, can you speak in further detail to the 6-month reserves needed for FHA?
Yeah, so the 6 months reserves means 6 months of a housing payment. So if it's $1,000 mortgage payment, then they need $6,000. The good news is that can be a gift as well. So if you have a family member that's giving the gift, if they're able to go ahead and give a little bigger gift, we're not going to go ahead and check afterwards to see what happened with those gift funds if they decide they want to be nice and give it back. But it just has to be at least 6 months reserved from their own or a family member.
Yeah, that's great. And that's just for FHA loans, right?
That is for FHA. However, conventional, also having self-employed or rental properties are having reserve requirements potentially. So
okay.
We can go that further as well.
Yeah. Yeah, and I'm curious, you mentioned like obviously the food industry and you mentioned like engineers. Are there any other industries that you're noticing that like, oh, these are like really big problem industries right now?
Thankfully, we haven't had, I mean, it's some of the other obvious ones I feel like is hairstylists, people that work on commission base. Commission is a big one, of course. They haven't been able to go out and sell products in a lot of industries. Even like medical devices and so on, they haven't been able to get into the hospitals to go ahead and sell. Thankfully, we haven't had many issues with clients not qualifying. It's been actually very, very minimal so far. But I think we're going to see more of that for sure.
Yeah.
One last thing on that is I really think Indianapolis, though, geographically, I think it's not as bad as a lot of other parts of the country. Personally, is because we don't have a huge tourism area, places like Vegas. We have a lot of hotels, casinos, and economies that relied on that. I think Indianapolis has a lot of kind of more stable jobs, a lot of IT engineers and so on.
Yeah, I agree. That's what Mark was even talking a couple of weeks ago about, like how we fared through the Great Recession and that Indy's housing market wasn't hit quite as drastically as other cities were, which is great.
Yep.
Matt, can you talk a little bit about like what are some creative ways that home buyers, what are some creative ways that home buyers can do to get the opportunity to finance?
Sorry, my kids were waving at me there. Had a feeling that was going to happen. Some creative ways. So, one is a renovation product to where if you find a house that isn't quite exactly what they want and they don't have the money to go ahead and pay for all the improvements out of pocket, there are ways to go ahead and roll that into the mortgage. And that can be done as an FHA, or now there's a conventional product that does that as well. One key though on that is that's not a HGTV kind of thing where someone just watched it and they're like, oh, we're gonna go to Lowe's and buy it or go ahead and pick everything out and we're gonna do it ourselves. They do have to have a contractor. So that is important.
That's helpful. Like the HGTV thing doesn't ever work out the way people think it will anyway. So yeah, contractor's great. Guys, I'm going to ask, I know we're like, I kind of went through those quickly. What questions do you guys have? Anything that you would like to ask Matt specifically about what's going on during the pandemic, or just lending questions in general? Matt, can you talk about first-time homebuyer programs?
Yeah, there's actually a great one. So there's a few different ones. So there's actually agency is Indiana Housing Community Development Authority, basically Indiana Housing. They have a number of different programs where they can help with down payment, whether that can be even a first-time or not first-time home buyer. But they also have another program that there isn't anything in the state of Indiana that has found more powerful than this, and been working with them for the last 18 years, is they actually offer tax credits. So it depends on the income of the individuals, depends on the price of the home, depends how long they're gonna live there, whether it makes sense. But it's something that they have the opportunity to actually get 20% of the mortgage interest they pay. They can get that back every year when they file their tax returns, which since the 2018 tax reform, standard deductions are so high, meaning that an individual can take $13,000 as their standard deductions, or a married couple is $26,000. Here in Indiana, that generally exceeds the amount of charitable contributions they make, state income tax, mortgage interest, property tax. So they really don't get the benefit for mortgage interest anymore. So this allows them to be able to get that back, which can be pretty powerful. It could be something that's, someone buying a $150,000 house, they may get $1,000 or $1,100 back every year they live in the house.
That's great. Matt, any programs that don't have PMI with less than 20% down?
There are, but anytime, unless there's some portfolio loans out there with different lenders. I think there's a couple of them. I know they could be kind of more of a CRA kind of situation, I believe. We don't do those personally. And I know those come with a lot of restrictions geographically, or the income of the borrower and so on. But otherwise, on any conforming Fannie Mae, Freddie Mac program, you have to, if you put less than 20% down, you have to pay in some form or fashion. So that could be monthly PMI. It could be a buying out of it, like a premium up front, or the lender could increase the rate a little bit to get rid of it. But quite honestly, as the monthly PMI has become so incredibly cheap, now that the PMI companies have shifted the model to where they're really rewarding higher credit scores, and monthly PMI could be $20, $30, $40, $50 a month, and it goes away once you get to the 80%. So it's much easier to get rid of, and it typically works out mathematically better than the other options.
Yeah, I had no idea it could be that low. That's fantastic.
It could be, yeah. It all depends on how much they're putting down in their credit scores, but the factors, I keep running these through, and I can't believe how low they've been lately.
That's awesome. Diane just asked about the PMI. Do you need to reappraise to show that they've made the 80%?
So it's up to the PMI company. The rules just changed recently. So it depends on when the mortgage was obtained. Those rules have shifted over time. So anytime that I'm giving the really safe answer. Anytime someone wants to go ahead and get rid of their PMI, they have to call the servicer, and they're going to look up their specific loan to see what category they fall within. But as of this last year, it's now once you get to the 80%, it should be removed. There are some times though the lender may require a broker's price opinion, costs $150 to go ahead and just make sure that the value hasn't decreased.
Matt, another question that came in, what are the terms of your renovation loans? Do they work like a construction loan?
Yeah. So what do you mean by the terms, I guess, if they could?
Good question. Jenny, can you unmute yourself and ask?
I'll try.
Okay, sure. I'm just wondering if you need good morning, Matt. I'm just wondering if you need specs and prints and the contractor, everything up front, does the property have to appraise, all of that?
Yes. So everything's going to be based on the new value after the improvements are done, subject to. So that's where we absolutely need the plans and specs, the bid. So that way the appraiser can go ahead and appraise it based on that.
Okay.
Then also the bids have to be put together to where, and we have formats that we can send over as examples, but it does need to be broken down between the labor and materials in each category. So that way, they know how to release those draws as they complete the project.
Do you have caps on it? Just has to appraise. So there's not $20,000 renovation cap or something like that?
No, there's not, except it has to stay within conforming limits. So the loan amount, so Fannie Mae is up to $510,000 now.
Okay.
They do have to have first-time home buyer could be as little as 3% down, but typically it's 5% down or more. So basically they're going to go ahead and add the purchase price plus the cost of improvements and make sure the appraisal is high enough.
Cool.
It's a pretty slick program. And actually what's nice is, especially if there isn't anything that's being done structurally. So if it's all cosmetic, like the kitchen being done, the flooring, maybe some wiring, whatever else, as long as they're not moving walls, load-bearing walls, then we can just go off the contractor's bid, and we don't have to have a consultant involved. So where FHA, for example, the 203Ks, they kind of turn into a nightmare a lot of times, especially when the HUD consultants and it gets a little messy. We'll actually just go off the bid from the contractor. That's it. So it's a great program. And the other thing too is that can be done on a primary residence, second home, and investment properties.
That's great. Thanks.
You're welcome.
Matt, are there any other loan programs that you guys run through Caliber that you're a huge fan of that everyone should know about?
That's
Sorry, I hit you out of left field and didn't tell you that one was coming. Sorry.
yeah, I saw Jess Martin there. MCC is mortgage credit certificates I talked about earlier. It's a great one, but honestly, so many of the programs are very similar these days. They really are, except, the renovation loans we just talked about are different, but, it is the kind of more of the conventional FHA, VA. VA is actually one we help a lot of veterans. So it is something we definitely do a lot of. I can't think of other programs that are out there, quite honestly.
That's totally fine. We just had a question from Jess come in. How is this spring compared to the last several springs? Are you seeing appraisal issues closing in 30 days or longer?
So have not been seeing appraisal issues. And actually, surprisingly, considering everything was kind of shut down there with COVID, closing volumes and units have actually been about spot on with last year, which is incredible. And actually I've been seeing things continue to pick up too, which is great. Regarding closing time frame, right now, just temporarily, if we can get a little longer than 30 days, it is helpful. Just because we've seen a little bit of appraisers being backlogged some. But the other thing is just the challenge of having to go back through and re-verify everyone's income within 72 hours of closing has been quite a feat. So that's taken an enormous amount of time, and then having the same amount of help, or same number of bodies as far as people processing the loans. So if we can get another 5 to 10 days, it is helpful. So we can't get them closed much faster, but again, as that volume is continuing to increase, it's just helpful.
That's great. Another question came in from Diane. Do you have any loan programs for investment homes that the owner wants to renovate after the tenant moves out?
Yeah, I mean, they could go ahead and purchase it and then turn around and do the renovation loan afterwards. That is doable. I mean, that's the only way they'd be able to do that. Otherwise, they, come up with the money on their own.
Are you still seeing a high volume of refinancing?
Yes and no. So across the industry, yes. We've actually, from the beginning all the way through this, we've actually, we always put priority, we always have put priority on our purchase business. So we've adjusted our pricing for refinances to go ahead and make sure that we don't go ahead and clog the pipeline with that. So we've always stayed close to the purchase for the realtors and so on a referral base, because refis come and go. Purchase is the most important thing. And so, yeah, we're fine on capacity levels in that regard. But I know of a number of lenders that have jammed those up so much that they can't take on any business right
now. What are your refinance terms?
If you could expand on that.
Jenny Bliss. I guess it's my day of asking short questions. Like 30 years, what interest rate would you get?
As far as interest rates go?
Yeah.
I mean, it depends on credit score, loan size, loan to value, and so on. I mean, they've 3 1/4-ish, 3 3/8. So they've been bouncing around a little bit, but right in that range, as long as it's good credit scores and loan to value. And purchase has been right around there, a little bit lower times.
Matt, I'm curious, when working with agents, I want to know those agents that you're like, God, I wish I could work every deal with this agent. They're just so on top of it. I love working with them. What do they do that makes your life so great?
Yeah, a few things. So one is sending over fully executed purchase agreements, page 8 signed, all the counters signed, not putting extra verbiage in there about certain repairs going to be done, because as soon as that's in there, then we have to go ahead and address it. So leaving those things out, not putting things in there about see addendum 1 through 24. Because now we have to go ahead and see all those documents. So that definitely on the front end, getting a clean purchase agreement and, again, fully executed. The other is communication along the way. So anytime, especially right now with having to juggle around with verifying incomes right before closing, and we have a 3-day window to do that. If there's anything that may jeopardize the closing date, like inspection responses that are going on, to let us know that there might be a delay or not. Or because, we work so hard at making sure we don't miss closing dates. And so there may be some complicated files that we're really, like Liz is busting her rear end to go ahead and make sure that we don't miss it. And then all of a sudden find out a couple days before closing, hey, we're going to go ahead and push this out. And they knew about it the week before. It would have been nice to kind of know. So it's really just kind of agents that are just open communication all the way through. So that way we can plan better is all.
That's great.
Yeah, I'll leave it there.
Sounds good. Okay, folks, we are wrapping up. Anything else that you would like to ask Matt why you got him on the line.
That was easy, only half hour.
We're letting you off easy this time, Matt. Just wait.
Yeah, that's all right. I'm ready for it.
Yeah. Okay, perfect. Well, I'm going to go ahead and wrap up. Guys, tomorrow we are joined by Shanda Johnson, Mark Nottingham, and Kelly Lavengood, and they're going to be walking us through how to price homes. I think that's going to be a great one. Hope you can make it. And then our last session of these 2 weeks is on Thursday. Crystal White is walking us through how to stay a boss. So thanks for coming and have a great day. Thanks, Matt.
We'll see you.
See you.